Hello. The annual report of First Real Estate Investment Trust is a relatively easy read compared to some of the others out there. It has fewer pages than some of the larger conglomerates, but as always, it still pays to turn past the glossy pages at the beginning and have a good read of the rest of the document. In the next couple of minutes, we'll do just that. First, let's turn to page 4, where you can see various charts of how the operations performed. First REIT invests in healthcare-related properties, mostly in Indonesia, although they also have 3 aged care homes in Singapore and property in Korea. Indonesia, though, helped to drive the gross revenue. You can see the arrow, the trend has been up for all of those years. Initially, it was a little bit bumpy, but you can see in the last couple of years, it's just been up and up. Look at that number there, 93 million Singapore dollars. That number is going to be important in a few moments because it's the number that we'll be looking for in terms of next year's revenue. More on that in a moment. First of all, let's figure out why they actually had that increase to $93 million in revenue. And the answer lies in part because of healthier earnings at the aged care homes in Singapore, but also because they acquired 2 new properties in Indonesia during the year under review. That's the 2014 financial year. And you can see those properties here on page 18 of the annual report. They are the Siloam Sriwijaya Hospital in Palembang on the left, and on the right, the Siloam Hospitals Purwakarta, which together cost them about 120 million Singapore dollars. On page 92, we have about as much as we can get out of the annual report in terms of a prognosis for next year's earnings. And I'm stretching it a little bit here because they didn't actually say it to this effect. But when we look at this particular line item here on page 92, which refers specifically to operating lease income commitments, where they say that they have the total future minimum lease receivables, non-cancelable, in other words, the amount of money that they're highly likely to make. What we see here is that there's a $100 million figure that they should be earning from these non-cancelable leases in the next year. 100 million compared to 93 million as they reported in 2014. By the way, this table also shows you that between years 2, 3 and 4, we should also see almost 400 million Sing dollars in revenue come in, and beyond that year, more than around 550 million. So you can see that there is quite a lot of rental income to come over the years ahead, which, in their words, is non-cancelable. Looking to net property income, you can see that curve has also risen, $91 million. Assets under management, 1.1 billion or so, a number that's grown in part through property revaluations, but in part through other assets as well. The distributable amount, here it is. The curve is also heading north, and the distribution per unit is now at its highest at 8.05 cents per unit. Unit holders, incidentally, have the option of reinvesting the dividend that they are paid, and in the last year they managed to raise about $17 million from the dividend reinvestment plan. Now, this has been good for them because they've been able to pay back some loans, and obviously rather than pay out the cash, by giving the shareholders the option to get more units, they can keep that cash in-house. The income, incidentally, comes increasingly from Indonesia as a percentage over overall income. On the left, you see in that ring chart, you see about 93% of rental income coming from Indonesia, 4% from Singapore, 2% from Korea. By the time 2014 rolled around, the Indonesian proportion had gone up to 95%, Korea having dropped to less than 1%. But it might not stay that way for long, because when you look at the Chairman and Chief Executive's joint statement from page 6, you can see that Albert Chok and Dr. Ronnie Tan have some plans in mind as to where the revenue is going to come from. Sure enough, Indonesia is still an important consideration for them, and they say that according to a Frost & Sullivan report, healthcare expenditure per capita is expected to grow around 14%. Over the next 4 years or so. So up to 2018, a compound annual growth rate of about 14% compared to less than 5% in the Asia Pacific. So clearly Indonesia is a place to be. Indonesia is also where they want to enhance some of their assets, read renovate them, increase the value and perhaps be able to charge more in terms of rental. They have 3 properties in mind, and that's also disclosed here in the chairman's statement, where they say that the Siloam Hospital Surabaya is likely to be the first, with the Kebon Jeruk and Aradutya Hotel and Country Club being the other 2 properties that might see a facelift in the year ahead. First REIT's sponsor, incidentally, has another 30 properties that might be injected at some stage. They've said this for some time now. The sponsor, which also owns the Siloam Hospital's brand, hasn't at this stage, or at least not according to this, given them any indication as to when those 30 hospitals might be signed across, or any one of those. But what's interesting, of course, is that First REIT has the first right of refusal. What you can also see here in this highlighted quotation from the Chairman and Chief Executive statement is that they are looking outside of Indonesia as well. They're saying they'll also look at opportunities in other parts of Asia to diversify their asset base. So nothing further said about that. Maybe you'd like to ask that at the annual general meeting, where else in Asia they're looking. Let's turn to page 43 now as we take a look at some of the finer details of the financials. So far, I've shown you some of the charts, and you can see how they were mostly up, up, and up. But there were some other things that were up as well, and that's possibly less pleasant in terms of profitability. Finance costs, for example, went from $12 to $15 million. The manager's fee also increased from 7.9, just almost $8 million, to more than $9 million, and half of that was in terms of a performance fee. The income tax has also rocketed, having gone from $1.5 million to $22 million. And the debt has gone from just under $360 million to more than $400 million, which would explain some of that increase in their finance costs. In terms of the net profit number, that's come down. Now, generally with REITs, we don't look at net profit too closely because they are trusts. And as unit holders, you have a direct access to the cash flow. You don't need to wait for the board to declare a dividend, like in other companies. Here, the cash flow is the unit holder's right. That's what you get as a part of owning units in a trust. So net profit is an accounting issue more than anything else, but there we've seen the number, just for the record, come down. A quick look at the balance sheet. And we see here that current assets are at $40 million, but current liabilities are almost $70 million. Good thing that First REIT generated cash flow during the financial year of around $80 million. The annual general meeting is coming up at the Marina Mandarin Hotel on the 30th of April at 10 a.m. You might like to go along if you're a unit holder.